going to begin by taking a look at what I'm referring to as a dual growth model between the US and China. And it's prefaced here with the word interdependence and imbalance. And we're going to get into that as simple as possible with some basic macroeconomic concepts. So, interdependence and imbalance as it relates to the dual growth model between the US and China. And that's going to be done using or exploring GDP and having a sense of a global trade interdependence. We want to have a full conversation on that. So we start with some basic macro concepts. Gross domestic product, the GDP equation. And dig back into your macro class if it's not too traumatic when you looked at the GDP as the equation of C plus I plus G plus X minus M. And if you need to remember, the C is consumption, the I is investment, the G is government spending, the X is exports, the M is imports. And I am going to focus on two components today. The C, which is the consumption, and the net exports, which is the X minus M, the exports minus imports. I'm focusing on US and China. Now, China has what's known as an export-led growth model. Go back to the GDP equation. You see all of these components? Well, if they change GDP. China focuses on the X in terms of growth. They have for the longest time. And we won't get into if they're changing or anything like that. But the focus here is China grows fundamentally through exports, the X. Now, the X is a trade variable. If they're growing through exports, somebody got to be buying it. They're trading partners. So when we look at this export-led growth, we have to remember that there's also another component associated with this where if China is exporting a lot, somebody has to be buying it. Okay? So you have that X minus M, which is net exports. They're growing fundamentally through exports and importing small amounts. So that X minus M is positive. Another thing I want to point out is, remember, we have lots of components, and as China is growing through exports, they are not consuming a lot. They consume a relatively small amount. So that X is big and that C is small. Okay? Now let's flip over to the US. The US, in terms of their growth model, they grow fundamentally through consumption. Now remember earlier when we talked about China growing through exports, and if they're exporting a lot, somebody has to be buying it. Well, that trading partner is the United States, who is buying those exports, one of the trading partners. So what that means is, as China grows through X, and they're selling to their trading partners, those trading partners are importing a lot. So what do we have? Export-led growth for China with a positive X minus M, that net exports is positive and big, huge surplus. They're exporting a lot, not importing a lot, because they're growing through the exports. And the trading partner, in this case, we're choosing the United States, is importing a lot because they're buying those exports. So their X minus M is a deficit. So China growing through exports, positive current surplus, huge and big. United States importing a lot of those exports, current account deficit, negative, and also big. And this is where things get a little bit sticky. Because some people might say, whoa, wait a minute, that seems like an imbalance right there. where they're exporting and growing and we gotta buy it. They have a surplus, we have a deficit. Now, as an economist, I want to remind you, let's go back. Here is the GDP equation. The focus I just gave was on that last set of variables in the equation, the x minus m. And if we really focus on it, we kind of have a dilemma because that focus shows the imbalance that I just had, where that x minus m is hugely positive for China and x minus m is usually negative for the United States. But it is not the complete picture. GDP has other components. And I want to show you something right here that we need to consider when we're having this conversation. I told you earlier that China does not consume a lot. With the United States, they tend to be huge consumers. So what we have here is China growing fundamentally through exports and the US focusing on the consumption component to grow. Now, why are we focused on this? So what is what some people say? Yeah, we grow through C, but what does that mean for us carrying a huge deficit while China carries a huge surplus when compared to a trading partner and the focus is on US and China? Again, the conversation is not complete. I want to focus on this particular identity, and I'm going to try to be as simple as possible. When you get your income, if you don't consume it, what's the other thing you do with it? You save it. So when you get your income, you either consume it or you save it, which means if you're consuming a lot, your savings is small. And if you're consuming a small amount, then your savings is big. Now let's go back to what we said. China, growing through exports, their C is small, which means their savings is huge. United States, growing through consumption, means their C is huge. Hence, their savings is small. Now, I'm hoping where you're seeing where I'm going here. US is growing through C, hence saving is small. China is growing through X, choosing to consume small amounts, so their savings is huge. What we have is an opportunity for exchange. Since China wants to grow through exports, and the United States wants to grow through consumption, what China does is, I'll use this term kind of loosely, China kind of sort of exports its savings to the United States. They say, okay, you want to grow through C and we want to grow through exports. This is what I'm calling the dual growth model. You want to grow through C, we want to grow through exports. We have a glut of savings here. Why don't we lend it to you and you consume as much as possible, but promise us you'll also consume our exports. You grow through your C, we'll lend you our savings, and we will grow through exports. We have this dual growth model that exists. China growing through X, we growing through C. We like to grow through C. We don't have enough savings. China has a lot of savings, so we borrow it or they export it to us. That's what we mean here with this dual growth model, this interdependence. China is exporting. We are buying. That's our imports. That's their exports. We have a deficit. They have a surplus on that net exports, but we grow through C by borrowing their savings. Now you might be going, borrowing their savings. How does that work? China buys a lot of the US Treasury bonds, the US instruments and securities that are considered some of the safest that exist globally. So their way of exporting their savings to us is by buying US securities. And they buy a lot of them, a lot of them. We grow through C, they grow through X. We borrow the savings by them buying those securities. And by heavily investing in these US securities, they get two things. They get to fund the consumption of the United States, which causes the consumption led growth in the United States. And they also get to keep their currency undervalued, which actually lets their exports grow even more. The point is, we have a interdependency, a link, a lock that exists with this entire growth model. The question then boils down to today. If our focus is now on net exports, we can't just isolate the X minus M. We have to take into consideration this interdependence. Questions about, is it fair? Should they be growing at the rate of the US trade deficit? Is there an imbalance that exists? Again, the conversation needs to be fully fleshed out with the entire GDP equation. There is some risk and there are some benefits. So we need to figure out, if we're going to focus on net exports, what are these disruptions that exist? If we're going to start putting tariffs in place, if we're going to start focusing on X minus M, if we're going to start ripping apart and figuring out that the US wants to grow through export, they want to lower the deficit, what does that mean for the consumption driven component? What does that mean for the US securities that exist? What does that mean for funding China's exports? This is just a call for a broader perspective, a broader conversation, and realizing that all components of the GDP equation matter. It's very worrying to me that we have chosen to isolate just one part of this equation and we're not taking into consideration a full picture. We're not taking into consideration the savings, the consumption, and the investment component. So, what do we need to do? What does the rebalancing look like? I argue it's not aggression, it's not isolation. It really is about cooperation. It really needs to be global integration. And I'm going to use this word. It is not bullying. It is not this type of fighting that we see happening because we have not really sat down and looked at the entire picture. So, what happens if China stops buying US debt? Can the US grow without these large deficits? China has been focusing some of its attention on being a consumption-led economy. What does that mean in terms of access to that glut of savings? Do we need time? Do we need discussions? Do we need to just pull the band-aid off? These are just some questions that we want to focus on. You see the variables here? Look at the China savings rate. Look at the US savings rate. So as we close that gap and we shift our focus, what does that look like? What does that mean? Look at these trade balances and the gap that exists. Are we going to just fix this immediately? What about these holdings of US treasuries that exist? Just larger conversations for us to have.